Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. Today, John Manfreda and I are joined by another special guest. Our special guest today is former Wall Street executive at both Goldman Sachs and Bear Stearns, and she has now turned into an author of multiple books, and she is a whistleblower. Her name is Nomi Prins. Nomi, welcome to our podcast.
Thank you so much for having me on.
Hey, Nomi. My first question I actually wanted to get to is when people hear about Wall Street today, it's always about the Occupy Wall Street movement. And when you look at the majority of them, not all, there are some like anarchists or libertarians, but the majority of them don't really see government as the problem. They call for more government. And I was wondering if you could speak to them about, like, I think their solutions are sort of scary, but the government's role they've played in this crisis that's come. What could you tell them about? Would you speak about, like, the government and regulators and Wall Street are colluding, or what would you tell them? Well,
I think it's a good point. I think a lot of the people involved in the Occupy movements have different ranges of what they're concerned about, but also what they know in terms of the details of how the economy and how their situations were, and the country's situation was impacted by Wall Street and by the government and by regulators who were MIA from the SEC up through the Federal Reserve, or not necessarily MIA, but actually enablers of this kind of casino mentality of Wall Street, which was always there, but which kind of geared up in a massive way over the 5 years really between 2002, 2003, and 2008 when we saw the financial collapse in 2008 in the fall, on the back of the subprime assets that were created out of subprime loans. So it wasn't really the subprime market so much as a subprime securitization market and CDOs and all the sort of speculative securities that were created from the back of very few loans, and how those all were leveraged and then massively deflated and degenerated into an economic collapse. And I think all those details aren't specifically known by every Occupy Wall Streeter, but I think they know that something bad happened, that there was a lot of speculation gone wrong, and that the government has done very little to, A, stop that from happening while it was building up, and B, ensure that it won't happen again. And I think that's really the impetus for being out in the streets. And, we don't really have confidence here that the government gets it, that the regulators are doing their jobs, and that we as an economy, largest economy in the world and a significant population size, are safe in that environment from a financial perspective.
Yeah, that's some good points, Nomi. And, some of these protesters do understand some of the truth about what's really happening, how these banks could have never gotten this large or leveraged without the Federal Reserve backstopping them. In a free market, a lot of these guys would have been bankrupt a long time ago.
Well, exactly. The Federal Reserve not only bankrolls the large banks more significantly than the smaller banks by virtue of the fact that they actually have more shares in the Federal Reserve, and they're on boards of the Federal Reserve, and they have a lot of relationships there, and there's this sort of collusive relationship that the Fed also is supposed to, as a regulator, as a watcher of the banks and how their actions will impact the rest of the country, is supposed to be able to say things like, this particular merger shouldn't happen. This big bank shouldn't become bigger. And yet what our Fed has done is at every single opportunity, growing into this particular crisis period, has basically given the green light to any bank to merge with any other bank. And after the repeal of Glass-Steagall in 1999, for any bank to merge with any insurance company, to have a trading arm, to have a deposit, arm and loan arm on the commercial banking side with individuals and so forth, all under one umbrella. And in the financial crisis of 2008, they amped up that inability to say no to big banks becoming bigger by basically pushing big banks to become bigger, as was evident in the merger of Bank of America with Merrill Lynch, which was a dog to begin with of a company. It was like hemorrhaging value while the deal was being discussed, like by the second, and it was still pushed through by the Federal Reserve, the Treasury Department. The merger of J.P. Morgan Chase with Washington Mutual also was pushed through. The acquisition of Bear Stearns earlier in 2008, in March 2008, was funded by the Federal Reserve. It still effectively has a $29 billion book of guarantees against assets Bear Stearns was holding into that merger, so that the risk isn't taken on by J.P. Morgan Chase. So, you have basically these situations where these big banks not only become bigger, but the Federal Reserve finances the acquisition. It's like the Federal Reserve is an investment bank to the banking system rather than being the regulator it is supposed to be.
Yeah, that's an excellent point. And what always baffles me is the Federal Reserve will claim how it wants its anytime there's an audit of it or any type of action, they always say their quote-unquote independence is endangered. And in reality, if you look at them, first off, based on political independence, the president appoints the head, so there's already a conflict of interest right off the bat. But you just brought up an excellent point. They're not independent from Wall Street. They do, at least from what I see, you knew on the inside, but they're always trying to lower interest rates so Wall Street gets cheap money. They're always catering towards Wall. They're not independent from Wall Street at all either. So it just baffles me. The media will never talk about how the Fed's not really independent. They're appointed by the president, and Wall Street, they're not independent from Wall Street. So
no, they're not. First of all, as you mentioned in the beginning, the fact that the presidents appoint, and yes, Congress has to approve, but they've never not approved an appointee of the president for the Federal Reserve, and they have 14-year limits for being the head, which is a tremendous amount of years to be at the helm of something as powerful as effectively a bank whose shares are owned by the biggest banks proportionately, and who can print money and lower rates and buy securities in order to ensure rates remain low and so forth, really with impunity. So, on the one hand, and Federal Reserve chairmen tend to exist through whoever is in office. This particular one, Ben Bernanke, was, of course, appointed originally by George Bush, a Republican, reappointed by Obama, Democrat. So there's no, they kind of transcend above any party anyway. Not that either party is particularly good at regulating or discussing regulation of the banking system, but yeah, certainly from the Federal Reserve even head perspective, it doesn't happen. From the standpoint of the fact that the Federal Reserve both has the ability to print money, i.e. reduce rates, buy whatever assets they want, take whatever assets they want from banks for collateral for the money that they then provide to banks, and basically make all these rules, which are a part of the Federal Reserve Act, but because there were so many points of the Federal Reserve Act of 1914 that have kind of loopholes in them or have the ability, for example, in emergency, quote, situations to be run around, which the Fed does quite well, particularly as they did in the fall of 2008 and then later on in 2009 and still, that it has every impetus to help the banking system that it is a part of. The Federal Reserve is an entity that is part of the banking system. It is Matt Taibbi used this term, so I'm going to steal it from him, but it is like an ATM for the banking system, except without fees. So, whereas we might have to, pay fees for the money we take out of our own accounts. Banks don't really have to pay anything near that percentage to get money out of the Fed, and yet the Fed is supposed to be its watchdog. So that there's a conflict of interest just in the sheer makeup of the Federal Reserve, aside from all the political relationships that occur within the board members and the board of directors and the chairman himself.
Yeah, and the free money that Wall Street is, or close to free money that Wall Street is speculating with, is, not coming out of just thin air, basically. It's coming out of the purchasing power of American savers and American workers. So we have, diminishing purchasing power every time they get, another stimulus program to go and speculate with more capital.
Well, exactly, because if they're speculating with more capital and the items into which they can speculate at any given moment, whether, for example, they're commodities like whether they're oil or wheat or rice or sugar or whatever, cotton, these things all then have the ability to increase in price, which, of course, if we purchase anything made of them, also increases our price of purchase. But also, even if you're not talking about specific commodities that are being speculated into, you have the fact that the Treasury Department issued $4 trillion worth of debt since 2008 in order to supposedly bolster up our economy. And it had said, and Tim Geithner, Treasury Secretary, had his on record as saying that that's kind of the purpose of the extra debt that was created. And as we know, we've had all these debt cap arguments in Congress and sort of hand waving and back and forth and blame throwing and everything else recently. But the reality is that debt was incurred by the country as a whole in order to float the banking system. And for example, the banks borrow money from the Fed at nothing. They purchase Treasury securities, effectively then loan that money to the Treasury Department to buy securities. Those securities pay back to those banks an interest rate because it's like a loan. But the banks put those securities back to the Fed, so now they're on the Fed books. The Fed has basically lent the banking sector money to go purchase the debt of the Treasury Department, put those securities back on the Fed's books, and receive interest from the Fed for having kept them there. And those securities get to count by sitting at the Fed and on the Fed's books as collateral for the banks to go and speculate and do whatever they want aside from that. So there's this entire circular relationship between the Fed, the Treasury Department, and the banks that incur debt for our country, that devalue our country's economy, our country's book, if our country were a company, and yet does nothing productive to enhance the value of our economy.
And that is a great transition, Nomi. You gave me a great transition to my next question. I want to talk about when the American economy was thriving its most in the history, before really the Great Depression in 1929, how what was Wall Street's, original role, as this happened after also the Great Depression in 1929 too, during the 50s, when productive American businesses were being grown here in the United States, and Wall Street's interests were connected with Main Street's USA's interests, and Wall Street was helping to finance and grow American businesses to create more productive American jobs.
Right, and that was also a period of time where there was the most regulation on the banking sector, such that the purpose of the major banks was effectively to evaluate and provide financing for the growth of companies, the growth of production, the paying of salaries, anything that you would use a loan for within a business environment. But they were fairly regulated in terms of not being able to then go around on the other side of their books and create esoteric securities and speculate with them and create all of this kind of ether in the financial atmosphere that doesn't or didn't help the productive growth of the United States and the United States economy. And that was because we had the Glass-Steagall Act in 1933 that was passed during the Great Depression basically disallowed banks from being able to both speculate and trade, and then also provide capital to individuals and to businesses on the other, and take their deposits on the other side. And that kind of contained the risk in the situation and also therefore allow the economy to grow. And even in 1956 and 1970, the Glass-Steagall Act that separated those banks was actually even strengthened with additional bank holding company acts that disallowed banks from purchasing things that weren't, or other companies within their umbrella, within their company that weren't doing specific bank business or going across state lines and so forth. And so there was additional regulation was even added during the 50s and up through 1970 to ensure that the financing of American businesses and the growth of American businesses was kept from the risk of any kind of trading or any kind of speculation that might go on. And that worked.
Yeah, and we've gotten to the point where a lot of these larger banks, Nomi, I think Bank of America, they were taking their depositors, they're a commercial bank, I mean, they're integrated now, but they were taking their commercial bank capital, which is not really supposed to be invested really in anything but, treasuries, and they were buying, credit defaults, or they were selling, financing credit default swaps on naked Greek debt or some ridiculous thing like that, and it's just a head-scratcher about, the banking industry, and, why are they doing all of this?
Well, they're doing it because they can. Because since because since Glass-Steagall was repealed, and even before that, 1999 repeal, there was a lot of swipes at regulation anyway to sort of make it easier for banks to do more things that weren't necessarily related to providing capital for individuals and businesses to grow. And what happened because of that was that they decided, well, this is it's an easier way for us to make money if we turn around and sort of say we are actually trading companies that have financing provided to us because we also have deposits, so we have those insured by the FDIC. We have financing available to us through the Fed. So basically, we're going to really do whatever we want on the other side. And as a result, even into the repeal, but late 80s through the 90s and forward, that's when you saw all of the really mega ballooning bonuses and compensations and everything else. They were never so intense. It was always the idea is you could always make money on Wall Street relative to Main Street, but you didn't have the sheer difference until those institutions were allowed to trade and to speculate and to get involved in country to country situations in terms of speculation and currency speculation and credit default and credit the integrity of countries from a credit perspective. Speculation and all this stuff was able to happen because there was money on the other side that was insured, and there was an avenue into the Federal Reserve by which more money could be gotten. So, all of a sudden you have this ability to do whatever you want, really, and trade wherever you think you can make a buck as fast as you can make it, and that was basically what banks went off and did.
Yeah. And that sounds exactly like predatory capitalism, Nomi, which for our listeners who are not familiar is something that basically Milton Friedman in the more modern era kind of came up with. And that's where Milton Friedman basically said that, and this was, espoused by all the top business schools for all the executives that are now running companies, is that, every single cent should be maximized in terms of short-term profit. But, for someone who's running a business, if you're designing a company that lasts, that's not smart to try to maximize every single profit, because what kind of risks are you taking about your company and, the other things in the long term?
Right, exactly. And that the idea of that long term versus the short term mentality, well, as we were talking about just before, is that if you have a long term mentality as to how your capital gets used, whether it's a company who's looking for financing or whether it is a bank that is offering that financing, and even looking at that company as a potential client down the line because they will acquire and merge and do all of these things along the line, and that's where the sort of investment banking classical role comes in, that you have to somewhat care about their long-term growth. Whereas if you are able to borrow fast and speculate fast and get in and out of markets and in and out of deals and in and out of companies, from a banking perspective, you don't have to care about the long-term growth of those companies, those clients at all. And that shift from financing being a long-term mechanism for growth versus financing being a short-term mechanism for trading profits, once that tips the scale into short term, that's when all this additional risk comes into the system. That's when all the bonuses are blowing up. That's when all the analysts come in and really only care about quarterly earnings of those financial institutions involved in these transactions, and not how they're doing over 3 years or 5 years or any sort of a long-term horizon. Everything gets cut to market flow today and bets right now. And add to that, what's happened is the continued technological development in the financial markets, which allows all of that short-term transactions to become even more short-term because there's a lot of instantaneous flow of money. That, again, exacerbates the problem even further and gets it even further away from the notion that capital, when it is used for long-term productive growth and planning as such. I'm not saying just because there's capital it means all of a sudden a company is good or that jobs are created, but it means that the planning is such that will be a result. But we don't have, we are further and further away from that every day, and without examining that very nature of finance right now, that we're not long-term productive capital, we're short-term speculative capital in general, and that the institutions that provide the capital and receive the backing from the government to keep the whole thing going don't care about the long term. That's when we're going to continue to see not just the crisis happened in 2008, but what we're seeing now, which is the fallout in Europe, the continued zombie-like status of the banks, the continued deterioration of our economy, the non-development of jobs and new businesses, and all of that's really just going to continue to decay.
That's some excellent insight.
Which is really depressing, but it's just true.
Yeah, I agree. It's a lot of things are going to be decayed and everything. And one thing I was very interested. I was listening to some of your interviews yesterday, and you were talking about Wall Street CEOs will testify to Congress, and they'll always use this. Why would we want to try to take all these risks and have our business fail? They would say, our customers lose, we lose, we can't continue to run the business and make profit. But you brought up an interesting point. These aren't like a normal pizza shop or a sporting goods store. They could make profit from their collapse. The way I see is through shorting their own stocks or buying puts on their stocks. So if they, if the business goes bankrupt, they win. But if they profit, they'll just pay themselves huge bonuses. Can you go into detail or explain how this isn't your typical business, how they could profit from their own bank collapsing?
Well, the thing is they can short. They could short their bank stock, but they can short because the banks are so complex, there's so many pockets within them that some are making money, some aren't. Some involve securities that they can short, or commodities they can short, or derivatives they can short at any time. So they can basically make money out of market failure or market decline or securities decline, number one. And number two, what we've seen is that if they fail as a whole, or they're about to fail as a whole, they get bailed down, subsidized by the government. So the bigger the institution is, the more likely it is to take risks and not care, and be able to even make money if things fail. And that's really what we have now, is that the biggest six institutions have this line into the government, were subsidized throughout the crisis period, continue to receive money at nothing. So they basically have the ability to ride out any negativity, and meanwhile they have the ability to short positions, short their clients' positions, and a whole host of other things that are really just about trading and not about operating a financing institution.
Yeah, and I think that's the exact problem with the economy, Nomi. I think you really nailed it on the head, is we have way too many, hedge funds and predatory capitalists, and not enough, angel investors and venture capitalist people who are willing to take calculated risks and invest in American entrepreneurs to create and grow American jobs. Because, no matter how much money I see government throw at the problem still, I'm just not seeing any job creation really here in the U.S. except for more government jobs.
Right, exactly, and even government jobs. You're seeing that, like on the state level, for example, because states are facing tremendous potential bankruptcies of their own. That on that level, the government jobs are actually being cut. So you have teachers being cut, you have fire stations being deleted, and so forth. You have the post office, which is a federal office being cut dramatically. So we actually have a lot of jobs coming out of the government sector as well, and we also have jobs being lost or not being created as quickly as our population is growing from the private sector, because most private companies, if they're big companies, they have the kind of relationships with these banks where they're sort of more able to get cheaper financing and so forth, or they're sitting on money, or they're throwing it overseas, or building plants or technological arms or whatever overseas and hiring people there, and not having an incentive to do that here. So they're not creating jobs here. In the middle level and smaller level companies that do tend to work more specifically close to home, to the country here, aren't getting loans to the same extent that they need them in order to provide the kind of growth that would also provide job growth and productivity growth and everything else. So it's part of that same problem that you have, financial institutions that can operate across the world and move money in and out very quickly and have any mistakes insured by the government. And then you have corporations, the larger ones can do the same thing, and then you have the middle and smaller ones not able to finance themselves, which is why you have this continued inability to grow our number of employed people.
Yeah, and Nomi, I'm a financial historian, so I like looking back at the past to kind of help predict what the future could be like. I mean, it's not going to end up exactly the same, but I'm seeing a lot of the same mistakes that politicians and Wall Street and the central banks and other stuff made in the 1920s and 30s, and I'm seeing a lot of the stuff repeated, except the U.S. economy, the fundamentals of the U.S. economy, prior to the crash in 1929 were a lot stronger back then. The U.S., had a very strong manufacturing base. They had a very strong export economy for manufacturing and also for farming.
Well, exactly, but though even at the time, they were certainly stronger than we are now, and even given that comparative strength, into the for example the crash of 1929, there was still a tremendous amount of speculation going on as they could at the banking level, by the biggest banks at the time, against a country that was already actually weakening economically, because a lot of the speculation was pulling capital into the markets and away from production, and yet it was still higher comparatively than it is now, which is why we're actually in a worse situation now than we were going into the crash in 1929 into what ultimately became the Great Depression.
Yeah, I agree completely. Our fundamentals are just horrible. It's we're basically an economy based on spending with a consumer that's broke. So there's only so much credit we can keep creating eventually until the foreigners. What people forget about credit card companies is a lot of that money they borrow comes from foreigners. It's not just treasury debt. And I think eventually the foreigners who have savings, when they realize they're not going to get their money back, they're going to stop loaning. And we're going to have to be able to only borrow from what Americans save, and that's going to be really bad. And they say not everything's exactly the same, and I think one difference will be right now, I think New York is is the next Detroit, and what I mean is Detroit used to be the auto capital of the world, but now it's just a place that makes cars. You see, Japan surpassing the Detroit auto industry. In fact, Japan employs more American auto workers than the U.S. companies, and I think you're going to see a similar thing with New York. Wall Street used to be the financial capital of the world, but I think, it'll eventually just be a place that does finance. And you'll see a lot of other exchanges, maybe surpassing them. Do you see any of that on a worldwide scale with Wall Street?
Well, I mean, that's interesting because when I think about Wall Street, there's the physical geography of the largest, U.S. banks being headquartered for the most part, not necessarily on Wall Street, but in New York, and Wall Street is kind of the old connotation of it. Used to really be that they were all on Wall Street. You had like the 6 largest banks during the 20s, of which all the banks today are incarnations of, basically within walking distance of the stock exchange downtown and on Wall Street. So that's kind of where that's stuck. But now a lot of these banks have global operations. and then, other countries have global operations as well. So everything has become such that you almost don't need a physical location to do your business from. And so you're able to take advantage of, better tax situations, less regulation, et cetera, and move businesses around to really maximize or, for you to consider how you maximize your profitability as a bank. But in the meantime, Wall Street here does have the connection through many of the banks to our depositors, to our population, who basically provide, in some instances, deposits that are insured, which give these banks kind of the leeway to do a lot of the other sort of globe-trotting that they do. So I think you're right. I think we may see the physical number of people and businesses that are actually happening on a day-to-day basis in New York, in the Wall Street area, diffuse globally. But I think also a lot of that is due to speculation that banks can do, is looking for the place to make the cheapest buck or the easiest buck, and the fact that central banks throughout the world, not just the Fed in the U.S., tend to finance the mistakes of the biggest banks throughout this whole process.
Money never sleeps, Nomi, and capital goes where it's treated best. Until that is, there's currency controls and capital controls and tariffs and competitive currency valuations, which is something I guess we're starting to see in that, someone like you who studied the 1920s and 1930s has also seen repeated in history during that time as well. I wanted to talk more about the Great Depression in 1929, Nomi, like some of the before events, some of the during events. Hello?
Yes.
Some of the during events and some of the after events. And you could talk about, tell our listeners about your new book and where that fits into the transition period of the United States and the world economy during those three separate segments of the Great Depression of 1929.
Yeah, well, my book, Black Tuesday, and the title is the date, which was Tuesday, October 29, 1929, where the stock market basically fell 11%, but it was a combination of a week of incredible volatility and volume of people and small companies and investors taking money out of the market because there became a sudden lack of confidence in the entire banking system, plus the fact that many of these people and investors and small companies had borrowed money in order to invest in the stock market and to invest in these things called trusts, which were basically pooled or sort of grouped together places, kind of like mutual funds, but they could also be shorted and long. So kind of like mini hedge funds, where people thought they were trading alongside the big boys, the banks that ran those trusts. Yet the banks had the information about what was in them, so they were sticking the stock of companies that they knew were going to fail or that they knew were showing some risks into these trusts so that they could convince investors to buy stock in the trust and buoy these companies up that didn't deserve to be so, which is very reminiscent of what we've seen nowadays with what happened with the subprime market, which is that banks were basically stuffing subprime loans into other types of securities and then telling investors that everything was okay and fine, even though they were seeing these subprime loans deteriorate, but still selling it on to kind of move the bag further and further up the road and take the money up front and then sort of dump the losses on investors later and get bailed out. In the 1920s, a lot of that was happening. We had a big housing market fall in 1927, and a lot of that was because even though the 20s were supposedly roaring and there was a lot of money being put into the market and banks were doing great and they were trying to get, the little people in to invest, and it was all about investing, or if you had a home to get a second home, if you didn't to get a mortgage and all of that. And a lot of people actually bought second homes. One big place for that was Florida, for example. When they started realizing that those homes didn't have the value that the banks appraised them at, which is very reminiscent of now, they started backing out or not being able to pay, and there was a little bit of a housing crash, and the banks paved that over by trying to figure out how to create these trusts and get people into the stock market. So it's like, well, if this investment doesn't work, we'll find you another one you can get into, and we'll be there first, and we'll get out first and make our profit, and then everything dumps on you. And we have the powerful relationships, and at that point, money from the Fed as well, or cheaper money from from the Fed as well, where we can basically be safe ourselves. And the book itself, though, Black Tuesday, is also, I mean, it's a story. It's not just about what happened actually historically. There's a mix of that history, that background of what was happening, how bankers were rigging the markets, and how they were misquoting the value of things and misrepresenting the value of things back then, which they definitely were, which led up to the crash, because once it was noted that things weren't quite what they appeared to be, people started either backing out or having to sell things in order to pay their margin calls on other things, and that crashed the market further. But the story in the book is also just about someone who this girl, Lila Khan, who's an immigrant who comes here from Russia, where there are these devastating things called pogroms there, where basically, Cossacks are annihilating, whole villages, and, everybody wants to get out, and comes to America to sort of have the American dream. She's got relatives here, like so many people did. She comes to live with them on the Lower East Side, which is a very impoverished place relative to just slightly further geographically downtown of Wall Street. And she's living in this fifth floor walk-up in this tenement building where she basically is, with 5 other people. Their bathroom is shared with like several other apartments. I mean, she's, the stairs are creaky. There's no light in the building. Like all this like stuff. And then she takes a job down on Wall Street where she comes into contact with the bankers. And one partner of the Morgan Bank, which was the prototype, was the actual Morgan Bank, which is down by, was down by the New York Stock Exchange there, which is headed by J.P. Morgan Jr. or Jack Morgan, who was one of the biggest financiers at the time. And she winds up meeting his nephew, who I created, who's fictitious, but easily could have existed. And they sort of have a thing. But in the process, she learns about what's really going on at these banks, and she goes home and finds that on the other side of that, and not to give the story away, but they've had what the banks have done and the fraud they've created have really hurt her family in very, very real, devastating ways. And so she's really caught in that between her heart and her head and her loyalty to her family and her passions, and sort of the story evolves from there.
That's a very interesting insight to your books, and I was wondering about your thoughts about the future of capitalism and free enterprise in the U.S. What do you think it holds? Do you think we could ever go back to a real free economy, and do you think things will have to get worse before they get better for the U.S. economy?
Well, I think things will get worse. Whether it's before they get better, it's not clear. But they'll get worse because, again, we have a situation where we're subsidizing too much risk in institutions that are too powerful, in an economy that does not have the capital to finance or strategically consider new ways to be productive and create jobs versus having the financial institutions trade and sort of speculate away. So we're in that situation now. So unless we basically have some like big wake up in terms of both regulation and just the fundamental notion that we don't really have a free market. I mean, the idea of a free market is that everybody has a shot and everybody has the same information and all of that. But I mean, that's not the case. You have the larger institutions who basically have all the information, and sort of people at the end of that long line of not having the information, somewhat investing, but right now basically losing money and not having jobs and companies closing and all that. So you don't have a situation that has the ability to get better. So that has to basically be addressed, and unfortunately we don't have politicians or regulators who have the ability to, think beyond the next election cycle or like the next, time they're going to leave the regulatory position and get a job on the street or a speaking gig or whatever, to be able to really deal with this.
That's a good point. You were talking about the trading and the loaning and everything, and right now, if you actually look about how we don't really have a free market, that's very true. Like, what people fail to understand is that when you have the Federal Reserve controlling interest rates, you can't have a free market because, generally speaking, when banks have very little assets or very little savings and they have to keep shedding jobs, in order to ask for capital from them, interest rates need to be high so they can build their capital base. But you don't see any of that. You don't see banks with different interest rates because some banks are more solvent than others. but that was just an excellent point. We don't have a free market, and you can't have one with the Federal Reserve System.
No, well, you can, exactly, because the biggest players have free money or pay basically no interest on their money, but yet they're the gatekeepers for anybody else who wants to take out a loan to grow a company on the other side where they can charge much more. So you actually have a very lopsided system. And I mean, banks always had the ability to be financed more cheaply or had pools of capital to begin with that they then lent out. I mean, that's how a lot of these banks actually started with Bank of America started, as Italian out in San Francisco had real money and was lending to his friends. So they started with real capital and then ultimately became a sort of Fed-backed capital situation where they were always getting money more cheaply than they were lending it out. And that in itself wasn't necessarily bad because, you would think that would give them more money to lend further and basically expand. But there's such a wide gap right now between the money that they're getting at nothing and the fact that they're not lending, or there isn't this strategic long-term growth notion between small and medium businesses in America and the financing they get. That's where we have this big disconnect and this big problem.
Yeah, exactly, Nomi. And the disconnect for our listeners, when you said the growth, is the growth on Main Street USA, where Wall Street's interests used to be aligned with Main Street's in the past when the American economy was its most successful in the past. And now, we have this tremendous disconnect where Wall Street can still profit where Main Street suffers.
Wall Street doesn't even need Main Street, is the point. The only thing that Wall Street needs kind of Main Street for is the fact that Main Street provides Wall Street with deposits and some semblance of regular loan business that kind of gives them a basis, like a cushion. But for the most part, they really, really do not need Main Street at all to run the kind of business that they run.
Yeah, and that's very sad, Nomi, to how things have changed over what was, Wall Street's original function, I guess, to, grow productive American jobs. I have one final question here, Nomi, and then we'll let you tell our listeners where they can find your work and where they can buy your book. My final question here is, during the 1980s, there was over 10,000 charges filed by prosecutors, according to Bill Black, for the savings and loan scandals, and a lot of those CEOs were in prison for a very long time, Charles Keating, those guys. I want to get into the psychology of a modern-day bankster. We'll use bankster in quotes. Do you think the threat of life in prison for fraud and other criminal charges, along with the risk of losing all one's net worth in civil suits from shareholders, would have stopped the financial crisis?
I don't know if it would have stopped. I think a lot of these people truly do not believe that they will be the ones to be caught, number one, or number two, kind of justify their actions. The whole notion, for example, Goldman Sachs basically saying that, we had these positions in these securities, and yes, they were short, but, that's because we're a market maker. Sometimes we're long, sometimes we're short. We weren't really betting against our clients. That was just part of, what we do elsewhere in our, business model or whatever. I think those kinds of justifications are always going on in the heads of these guys. And so I don't know if it would have completely, having that threat, that very real likelihood would have necessarily stopped it. That said, not having it at all makes it impossible to even consider it might stop the kind of business that has so much less risk for these institutions and their executives and their CEOs than it does for the rest of the population. And what's really astonishing, looking at Bill Black's numbers and also the fact that even Drexel Burnham in '89 had a $1.2 billion fine and pled guilty to securities fraud. Right now, not only has no one gotten to jail, not a single company has pled guilty to a single count of securities fraud, to a single count of we knew what we were stuffing in these securities and we didn't tell you everything. Not that basic, that simple. That thing that went on every day has not even been accounted for. So I
Exactly.
think if there was more of that, yes, it might deter, make some things more careful, less risky for the rest of us. But the fact that this particular period in which we live, that this particular Department of Justice, this particular Washington, these particular regulators, these particular banks are just going about as if sort of nothing happened, with some settlements here and there that aren't accompanied by any admissions of guilt or any convictions or any indictments is very, very sad.
Yeah, that is true. It is sad what's happened, but I was actually wondering, I wanted to get your view on this, because I look at, when I look at the press, you see Wall Street and how they're vilified and how they're associated with, bad, what's wrong with capitalism.
Evil, greedy CEOs, yeah.
But then you look at them talk about Buffett, and they say, oh, he's this, all-American country boy from Omaha. Has nothing but vanilla ice cream, and he says derivatives are weapons of mass destruction. But when you actually look at him, he has openly admitted to Congress that he uses derivatives. He owns Goldman Sachs. He has huge shares in that, huge shares of Wells Fargo. He has, he just bought a boatload of Bank of America, and he basically owns most of these Wall Street stocks. And I was wondering, do you associate Buffett with Wall Street?
Well, yeah. I mean, a lot of his financing comes through Wall Street. A lot of his investments are through Wall Street. I mean, absolutely. This idea that he's just kind of, he might have a slightly different moral compass than some of these people, because he's been at it a long time, and he has had his philosophies of longer term growth and longer term investments. Although he's not dumb, and he's basically been able to sort of shift as well. Berkshire Hathaway has a major derivative shop, so I mean, it's not like he didn't figure out how to move with the times. So he's very much a part of Wall Street.
Yeah, and he has a $5 billion. He sold a naked put, and he raised $5 billion that the S&P 500 wouldn't collapse or whatever in the next 4 or 5 years. So yeah, I mean, I think he's kind of a crony capitalist now. I grew up rooting for him, reading books about the value investing and stuff, and now I just feel that was basically spin, that was sugarcoating, and I feel like he's more of a hypocrite now.
Well, yes, and he's in the position to be allowed to be a hypocrite. He's got Washington's ear and he's got Wall Street's ear. I mean, he's in a very good position to do that.
Yeah, I agree. I'm still shocked and enamored how Buffett has this all-American image still, and yet you look at what he's doing. He's definitely not some sort of country boy in Omaha. So that's what just shocks me, how most people still idolize him, but then badmouth Wall Street. It's I don't know.
I think everybody has their own persona they create, but he's certainly very much a part of it.
He can afford a good marketing budget.
Yes, definitely.
Well, Nomi, I want to thank you very much for joining us on this interview. Thank you very much for the opportunity. And can you please tell our listeners where they can find your work, your articles, and where they can purchase your books?
Yeah, absolutely. I mean, you just go to my website, basically, is the easiest way, www.nomiprins.com. It's NOMIPRINS.com. And there's a link right there to go over to Amazon to get Black Tuesday, which is my most recent book that's just out now, as well as links to some of my other books, or you can go straight to Amazon and look it up as well. And then all of my other articles and reports and blog is also, you can also get to it through my main website page.
Thank you very much.
Thank you, guys. Thank you both.